This is Al Brooks, and this is my price action trading course. The current module has to do with orders. For entry orders, beginners should only be entering on stops. You want the trend to be sweeping you into the trade. You want to be carried in by the momentum, even if it's only one tick in the direction of the trend. So how to enter on a stop? You're buying or selling the breakout of the prior bar. It's a great way to trade when there are swings or trends, but it's a terrible way to trade in the market when the market is in a tight sideways market. In other words, a tight trading range. So if the market's in a tight trading range, don't use stop entries, and beginners in fact should not trade at all. Experienced traders can also enter with market orders, for example during very strong breakouts, and with limit orders, either during strong breakouts or in trading ranges, including very tight trading ranges. So for example, if there's a very tight trading range and the market falls below the low of the prior bar, experienced traders can buy at the low of the prior bar, looking for a scalp up. Remember, when you're entering with a limit order, you're entering in the direction that is opposite to the most recent tick. So if you're buying with a limit order, you're buying as the market is falling. So you have to know what you're doing in terms of reading price action if you're going to be buying a falling market. For example, it's buying below the low of the prior bar or selling above the high of the prior bar. So let's say the prior bar goes up, and you sell one tick above the high of the bar, or at the high, you place a limit order at the high of the bar to go short. You're selling as the market's going above the high of the prior bar. So you're betting that the breakout will fail, and you should only be doing that if you're very confident with your ability to read charts. Every bar with a tail is a failed breakout attempt. In other words, a trading range type bar, right? If lots of bars have tails, it's better to bet on failed breakouts. So if the market has lots of bars with tails, that means every time the market goes up, it finds sellers. Every time it goes down, it finds buyers. So if you're in a sideways market with lots of tails, you don't want to be entering with stops. Instead of betting that the breakout will have follow through, in other words, for example, buying with a stop above the high of the prior bar, it's better to bet that the breakout will fail and go the opposite direction. So experienced traders, rather than buying on a stop at one tick above the high of the prior bar, they'll place a limit order at the high of the prior bar to go short, betting that the breakout will fail. Okay, so if most of the bars have tails and there's a lot of overlap, the breakouts will fail. So it's a terrible environment for stop entries and a very good environment for limit order entries. Limit order entries are bets that breakouts will fail and that the market will reverse. So should you be using a stop order or a limit order to enter a trade? A stop order is betting on a successful breakout. A limit order is betting that the breakout will fail. So you have to look at the price action. If the market's having big swings up and down with very little overlap between the bars, and you have consecutive trend bars up and down, that's a great environment for stop orders. If you sell one tick below the low of this bear bar, it's a good bet that the market will go down far enough for a profitable trade. If you buy one tick above the high of this bull bar, it's a good bet that the momentum will continue up and you'll make a profit. So when you start to see consecutive trend bars, not much overlap, and pretty big swings, that's a very good environment for stop orders. It's also a good environment for market orders. During this bull spike or this bull spike, you can buy at the market, betting the market will continue. During this bear spike, it's a good market for entering on just at the market, betting the market will continue down. However, when the market transitions into this, lots of sideways bars, lots of overlapping bars, lots of big tails, lots of reversals, bear bar, bull bar, bear bar, bull bar, it's a terrible environment for stop orders. Breakouts are going to fail. If it goes below the low of the prior bar, it's probably going to go up. If it goes above the high of the prior bar, it's probably going to go down. So when you see a market that's starting to look like this, don't enter with stop orders. This is for more experienced traders, and they'll be trading with limit orders. They'll be buying with limit orders at the low of the prior bar and selling with limit orders above the high of the prior bar, looking for scalps. When you're entering with a stop order, for example, if you're going to buy on a stop, you place a buy stop order one tick above the high of the prior bar. That prior bar is the signal bar, and if you get filled, the bar in which you get filled is your entry bar. Again, you want to be swept into the trade by the market going in your direction. For example, here's a 2-bar reversal, a bear bar, a bull bar about equally strong, closing near its high. If you were buying above this signal bar, as soon as this bar closed, you place a buy stop at one tick above its high, hoping that the market will go above the high of that bar, hit your buy stop, and fill you. And that's what took place over here. This is the bar when you entered the trade, so this is your entry bar. The initial protective stop, one tick below the signal bar, and the profit target always at a minimum is at least as large as your stop, preferably 2 times as large as your stop. So for example, your protective stop is one tick below the signal bar. Your entry price is one tick above the signal bar. A minimum objective would be a measured move up based upon the height of your risk. All right, so this is how much you risked, and this is a measured move up equal to the distance between the 2 red bars, and that would be the minimum profit target that anyone should ever try to get. If you're trying to enter with a stop order and you're doubtful about whether or not the signal or setup is strong enough, don't take it, right? Wait for a second or third signal and then consider taking the trade. So it's, when in doubt, always stay out. So when in doubt, stay out and wait for a second signal or a third signal. For example, if you see this failed breakout, we have a trading range, a strong breakout, and we see a bull reversal bar for a possible long, and you look at it and you say, well, it's only a 1-tick body and it's after 3 pretty good bear bars, and these 2 are especially strong closing on their low tick. I don't want to buy that. I'll wait for a second signal. Here the market broke to the downside, and again we got a similar bull bar. At that point you can consider buying. Here you could say, well, I want to sell. We're pulling back to the moving average, but the signal bar is small compared to the bull bar, and the bull bar opened on its low tick, closed right on its high tick, so it's very strong. I'll wait to see if there's a second signal bar, and I'll take the second signal. Here the market tried to go up a second time and again had a bear bar closing on its low, so shorting 1 tick below the low of that bar would be your second signal, and you would have been filled over here. Over here, let's say the market's going up and you did not want to short this after 5 or 6 consecutive bull bars and a weak signal bar, so you don't short that, you wait for a second signal. You can argue, well, I don't know, this is a lower low, maybe I'll wait for a second push up, second new high. Here we got a second push up, maybe you'll short over here. There's a second entry short. Here's the first entry long after a 7-bar bear micro channel, 7 or 8 bars down. Here's the second signal. Again, not a great signal bar, but at least it's a second signal, and that increases the probability of success. When you're entering with limit orders, you're trading counter trend, right? If you're entering with a limit order to sell, the market has to go up for you to get filled. If you're placing a buy limit order, the market has to go down for you to get filled. So you're buying a falling market or you're selling a rising market. So you're trading counter trend, betting that the breakout above or below the prior bar will fail. Okay, if you're trading during a trend, during a breakout, betting that a reversal attempt will fail is much better, right? So if you're in a strong bull breakout, you don't want to be selling above the highs of bars. However, if you get 3 or 4 consecutive bull bars and then a bear reversal bar, you can place a limit order at the bottom of that bear bar, because that bear bar is an attempt to reverse a strong trend, and most reversal attempts in trends fail. So you can take that bet. So you can buy with a limit order below the low of that reversal bar. So when you're entering with a limit order, you're fading a breakout, you're betting on a reversal. When the market is at the top or bottom of a trading range, chances are any breakout attempt is going to fail. So if the market races up to the top of the trading range, has a small bull flag, chances are the breakout from that bull flag will fail. If the signal is weak enough, experienced traders will place a limit order above the high of the prior bar to go short, betting that the market will not break out. When a channel is weakening and evolving into a trading range, let's say you have a bear channel and you're starting to get a lot of buying pressure and you have a bear flag right at the bottom, experienced traders will place a limit order to buy at the low of the prior bar, betting that the next breakout will fail. So when the market's at the top of a trading range, experienced traders will sell above the high of a weak buy signal bar. And they'll also sell above prior highs, betting that breakouts will fail. And that's the correct assumption. When the market's at a bottom of a trading range, traders will buy below the low of a weak sell signal bar. If it's a weak sell signal at the bottom of a trading range, it probably will fail and the market will probably turn up. So experienced traders will buy below that bear signal bar, betting that the market will reverse. If the market is falling below a prior low at the bottom of a trading range, traders will also buy on a limit order there at that prior low, betting that the breakout will fail. So here's an example. Market's in a trading range, and we're starting to get very two-sided trading at the top of the trading range. Experienced traders will not buy above this bull bar. They'll look at this as a trading range and expect that the market will reverse down to the bottom of the range. So they'll, instead of buying at one tick above the high of this bar, they'll place a limit order at the high of the bar, betting that if the market goes above the high of the bar, their limit order will be filled and the attempt to break out will fail and the market will fall. They might use a protective stop based on a measured move, maybe based on the height of their signal bar. They may place a protective stop above the top of the swing high, especially since it had 3 pushes up. And minimum target would be, if they were very confident about the trade, they can go for a reward equal to their risk. If they're less confident, or if they think the market is going to trade down low, maybe they'll go for a profit of at least twice their risk. So if they sold here and their stop is 1 tick above the high of the swing, and they go for a profit target twice their risk, they would get out down here. They may try to get out down in the area of this higher low, or maybe even the low of the trading range. Top of a trading range, do not look to buy below the low of the prior bar. If this was a strong bull trend, you'd say, wow, it's going to go up a lot higher. Therefore, I'm going to be clever, and I'll place a limit order to buy 1 tick. I'll buy at the low of this bar, betting that the market will go higher. In general, when the market's in a trading range, you want to buy low, sell high. So you should only be looking to sell, and even trying to be clever, buying with a limit order at the bottom of the bar, betting that you're going to be getting an early entry into a big move up. That's not what to do. In a trading range, you buy low, sell high. Where high, you only look to sell. So you're not looking to buy with a limit order below this bar. You're looking to sell with a limit order at the high of this bar. And again, only experienced traders should be entering with limit orders, because I think it's too difficult emotionally for beginners to be buying when the market looks like this. The market's going up for 10 or 15 bars. It's very difficult for beginners to be selling when the market looks like this. It's going up for 10 or 15 bars and you're betting that the rally is going to fail. I think that's just too difficult for beginners to assess, make that judgment, and it's also too difficult for them to manage the trade. It's too stressful. Again, the market's in a trading range. You want to buy low, sell high, and scalp. We're low. Okay. You want a reward at least as large as your risk, but if the target is just too small, go for a bigger go for a bigger target. So, for example, let's say you placed a limit order to buy the low of the prior bar, betting that this 1 bar final flag or this 1 bar bear flag will fail, and there'll be buyers below, and the market will turn up. Okay, so your stop. Let's say your stop is below the low of the bear. So you enter here, your stop is 1 tick below, which is here. So your risk is actually very small. You could say, well, I'll get out with 1 time my risk. When the risk is small, it's usually better to go for more than just 1 time your initial risk. So at a minimum, I'd go for twice my initial risk. So if you bought at the low of this bar and you risked to 1 tick below this bar, the low of the bear, exiting twice your risk would be right here. And you can see lots of traders did exactly that because we got a tail there. Obviously, it's also a test of the moving average and a failed breakout above this prior bull reversal bar, right? But clearly a lot of traders exited here. And, I mentioned in an earlier module that when the market's starting to try to reverse, for example, here it's in a bear trend and you get a decent looking bull reversal bar, traders will start to scale in and they'll add on lower, and then they'll try to get out around their original entry price. So if they bought, let's say, this close or right around here, and the market sold off, maybe they bought more here, they'll get out of everything around their original entry price. And that's part of the reason for that tail. Okay, let's say you have a channel and it's beginning to weaken and turn into a trading range. Traders are going to look to fade breakouts from weak signals. So if you have a bull channel that's starting to get a lot of two-sided trading and you're now near the top of the channel and there's a buy signal, a small bull flag, traders, and it's weak, let's say a doji bar, traders will bet that it will fail and that the market will start to sell off and transition into a trading range. Again, this is only for more experienced traders. So if a channel looks like it's evolving into a trading range, and let's say it's a bull channel and you're at the top, traders will place limit orders at the high of the prior bar to go short, betting that if the market goes above the high of the prior bar, that breakout attempt will fail. In a weak bear channel, it's trading down and you get a small bear flag, traders will buy with a limit order at the low of the prior bar, the signal bar for the short, betting that the short will fail. So here's an example. Obviously a very weak bull trend, lots of prominent tails, not much in terms of consecutive bull bars, and now we're up at the high of the day, right? So traders see this bear inside bar and say, well, that's a pullback, it's a breakout pullback buy. However, we're at new highs on the day, right around the prior high of the day. The trend up is very weak. I'm going to start scaling into shorts. So instead of placing a buy stop at 1 tick above the high of this inside bar, expecting more up, traders instead will place a limit order to go short exactly at the high of that bar, betting that the market will go down. When the bar closes, they can calculate a measured move up and maybe use that or a tick or so above that for their protective stop. Once the market started to go down, they could then go for a reward equal to at least their risk. So the minimum profit target is at least their risk. What about when you're in a strong bull trend? Does it make sense to buy with a limit order? Absolutely. Okay. The market is turning up here. We gapped up, we pulled back, and we had a strong bull reversal bar. We have another bull reversal bar, and now we're breaking out to a new high of the day, and the market's closing on its very high tick. Most traders would look at this and say, wow, it's a bull trend day. We're probably going higher. What a lot of traders will do is, as soon as they see that strong close, they'll quickly place a limit order at the price of that close to buy. So if the market ticks 1 tick below, they'll get filled on a long, and that's exactly what happened. The next bar, it ticked 1 tick below that close, and it went up. And it went up because a lot of traders had buy limit orders and market orders as soon as that bar closed. Where's their initial stop? Probably at the bottom of this bar, since this is such a strong breakout bar. So now they know their risk. The probability is high, 60%. They feel confident the market's going higher. So they can go for a reward equal to their risk. So they just find out where the measured move is from their protective stop. It's right here. And they'll scalp out part or all of their trade. On a swing trade, on a strong bull trend like this, it's probably better to swing. But the swing stop stays down here or down here. So if you're going for a swing, the stop on the swing portion is below here or below the bottom of the bull spike. On the scalp portion, you can get out right there, based on a measured move from the bottom of this bull bar. Okay, here's that same very strong bull trend. You feel confident that the market is in a strong bull trend. It probably will get a second leg up. So what you can do is bet that every attempt to reverse the market will fail. And how do you place that bet? You place a limit order at the low of the prior bar to go long, to buy, a buy limit order. Your initial stop is probably below the bottom of the bull spike, maybe below the bottom of the breakout bar. But in any case, it's a reasonable trade to buy with limit orders at the bottom of bars, betting that each attempt to sell off will fail. We have another bull spike, small pullback after the breakout. Traders, and here's the reversal attempt. So we have a bull breakout, here's the reversal attempt, a very weak looking reversal attempt, so the reversal attempt will probably fail. Traders will place a limit order at the low of that bear signal bar, betting that the bear signal will fail, so they get long at that low for a scalp up or a swing. If the market is breaking out and you're extremely eager to get in, let's say it's a 5-minute chart and it's breaking out, and you want to get in before the bar closes because you don't want the bar to get too big. Remember, your stop would be beyond the bar. So if it's a bull trend, for example, the stop, and you wait for the bar to close, your stop is below the low of the bar. And if it's a big bar, it's far away. So a lot of traders don't want to risk that much. Plus, they're eager to get in as soon as possible. They can either buy at the market, or they can look at a smaller time frame chart, like a 1-minute chart. If the 1-minute chart has 4 or 5 consecutive good bull bars, and let's say in a bull breakout, simply buy at the market and place a limit order place a stop order below the bottom of the spike. Alternatively, instead of buying at the market, you can start placing limit orders at the low of the prior bar, right? Betting that any reversal attempt will fail. Again, putting your protective stop at the bottom of the spike. So here's an example. 5-minute chart on the left, 1-minute chart on the right. Over here, you see the market is probably becoming always in long. By the close of this bar, it is always in long. You could wait for the bar to close and buy at the market. Maybe put a stop below the low of the bar, or a stop below the bottom of the spike. Or you can look to the 1-minute chart. And at this point, you see 1, 2, 3, 4 bull bars, right? 4 consecutive bull bars. The context is good for a move up. You're eager to get long. Simply buy at the market on the 1-minute chart and put a stop below the bottom of the most recent bull spike. So below this bear bar, below that bull bar, maybe even simply below this 1-minute bull bar. Also, you can look to buy the first pullback, betting that the first attempt to reverse will fail. So you place a limit order to buy more at the low of this bar, did not get filled. You place a limit order to buy at the low of this bar, not get filled. Finally, you do get filled. Finally, there's a pullback. The market fell below the low of that bar, and your limit order to go long was filled. And then you can go back to the 5-minute chart to manage your trade. So this long entry corresponds probably to around the close of this doji bar. And that is the end of my module on orders.